Again, thanks for joining, everyone. Appreciate you being on. We're really excited about this project. This is our Southeast Portfolio webinar where we're going to dive into the deal specifics on the Southeast portfolio that we're currently open for funding, open to accredited investors. I am Tate Duryea, founder and CEO of Turbine Capital. We are becoming and fast becoming the largest network of airline pilot investors in the world. And we're happy to have everyone along for the ride. We'll talk a little bit more about who we are and what we do in a couple more slides. But in any case, we're going to be joined today by our CFO, Jim Morales, who is an absolute financial stud, who's helped us look over the underwriting on this deal and make sure that we really like it. Again, I personally went and toured all 9 of these portfolio properties with the operating partner back in April. And so we're going to be going through them right here. So let's jump in. First off, of course, we have a disclaimer. We do not offer tax, legal, or investment advice. Please do your own due diligence and seek your own counsel. This is an open offering. If you would like to participate, please go to our investor dashboard at turbinecap.investnext.com. We're very excited about our new investor dashboard. It's an excellent piece of software, and we're really excited to be on board with them. And hey, Jim, thanks for joining us. I figured we'd jump in here. Jim Morales, everyone. Are you muted?
Oh yeah, sorry.
Yeah, there we go.
Tech issues. There I am. Hey Tate.
Hey, how you doing?
Good.
Thanks for.
Get my video
excited.
going here too.
All right, sounds good. Well, in any case, all of the investor information pertaining to the offering can be found on our investor dashboard. Again, if we'll talk more about how to get on there at the end of the presentation, but the PPM, private placement memorandum, operating agreement, subscription agreement are all live there. And currently we are about 80% subscribed. We were able to increase our reservation amount with the sponsor just the other day from 2 million to 2.9 million to accommodate all of our investors. We're excited about that. And again, if you have any questions throughout the presentation, please just drop those questions into the chat box, and we can answer those in the Q&A section once we get there. So who are we? We are Turbine Capital. Like I said, we're fast becoming the largest network of airline pilot investors in the world. I'm the CEO and founder, Tate Duryea, and I started this company because I thought that there was a niche in the professional demographic of airline pilots that wasn't being served, which is providing excellent risk-adjusted return deals to a cohort of professionals who have limited exposure or not necessarily enough exposure to commercial real estate in their portfolios. So an investment company that empowers pilots to establish cash flow, multi-generation, generational wealth through high yield commercial real estate. And that's what we're here to do today. So anyway, now that we sort of set the table on what this is, we'll jump into the specifics of this deal. So it's 9 facilities in 8 different markets. It's a value add play, and we're buying it for $30 million. All the markets have strong fundamentals. We have expansion and operational improvements at every facility that will drive additional value. And there's also economies of scale that come from the shared labor across all of the properties. There's also industrial flex space and some retail, and it cash flows in year 1, which we love. So this is a quick look at the offering summary. This is under Regulation D, Section 506. It's a 506C offering. What that means is that we can only accept accredited investors. We'd love to offer it to everyone, but because we're able to talk about this publicly, we can only accept accredited investors, which means over $200,000 a year in income, or $300,000 jointly if you're married, or $1 million net worth, excluding your primary residence. We are now raising 2.9 instead of 2 million out of that $2.9 million equity stack. The target debt raise, our operating partners raising $23.3 million of private debt for a total raise of $36.2 million. So unit price, we have a published minimum of 50,000. This is your percentage ownership share of the project. There's a preferred return of 7%. Total 5-year return of 92.7%, target annualized return of 18.5, an internal rate of return of 15, and an equity multiple of 1.93, meaning you're going to get the 1 in 1.93 means that you're going to get your initial principal back plus an additional 93% of return over a targeted 5-year hold period. Equity investor projections are as follows. So when we say 18.5% average annualized return, that doesn't mean that you're going to get 18.5% year one. Doesn't mean that you're going to get anything in year one. We can't promise anything, right? But we are buying cash flowing assets. So we do expect there to be cash flow in year one, commensurate to about a 4% return in year one. And with the preferred return of 7% just means that the first 7% of operational cash flows that come off the property belong 100% to the investors. That means us. The operating partner doesn't take any profit split until after the investors have been paid their 7% return. And of course, that 18.5% of total return is inclusive of the sponsorship profit split. So that's after the sponsor has taken their cut for doing all the work for us. So year one, about $2,000 on a $50,000 share. Year two, cash flow dips a little bit because we're going to be expanding the facility significantly, and we're going to have to take on some additional mezzanine debt in order to fund those projects. But then after we lease those new projects up, obviously we get a nice bump in cash flow as those facilities start to lease up and we start to see the additional cash flow. And of course, we benefit from the additional value from those facilities as well. We do have an estimated tax loss in year one. What that means is that even though you've got cash flow in hand, in pocket, we're going to do a cost segregation study on the property, depreciate it, which is a phantom loss, right? Just for tax purposes. So we're going to depreciate it on paper, which means that that flows through to the investors. And we're expecting to get about a $12,500 tax write-off in year one due to bonus depreciation. So the feasibility analysis, this is a really important part of what we do, is looking at the feasibility analysis, the most important part of really any commercial real estate investment. We could literally spend 4 hours on this, but we tried to condense it into the most relevant information. The offering memorandum, which is available on our portal, has more information, but we just wanted to run through the high-level overview of the markets and then state by state. Starting with Florida, we are in Florida, Georgia, and Tennessee. So Florida is, everyone loves it. It's the third most populous state. There's a ton of people moving there. Florida's got a lower unemployment rate than the national rate and a lot of major industries. So we have 3 facilities in Florida: Ocala, Hudson, and Palatka. You'll notice we've got really nice population growth, except for the one in Palatka here at basically 0. The irony there, though, is that it's one of the best occupancy facilities, and the new expansion that they just opened is leasing up really, really fast. And the market is 99% occupied. It's a really well located facility in a really great market. Just happens to be not growing all that fast. Moving on to Georgia. Georgia is fantastic as well. Very business friendly state, home to 17 of the Fortune 500 companies, and a lot of people moving there. Strong employment growth in the state's healthcare based industries, and a lower unemployment rate than the national rate. We've got 5 facilities in Georgia: one in Columbus, which is the home of Fort Benning, one in Fort Oglethorpe, Fortson, Lake Park, and Warner Robins. And you can see right here, we've got expansion planned at 4 out of these 5 facilities. Good income growth numbers and good population growth numbers across the board, except for say Columbus, but that's a pretty transient market anyway because of the military base, which isn't going anywhere there. And in Tennessee, we've got one facility in Tennessee. This one is about an hour southwest of Nashville. Tennessee is a great market, growing like crazy. Big population influx here. The facility here, as you can see, occupancy is very low. This is one that's been kind of neglected for the past 5-7 years and needs some serious work. But the occupancy in the market is actually very high at 96%. So this one will be a very, very attractive turnaround play. So let's go back straight down into the specific properties now. First one we're talking about is in Palatka, Florida. This is a beautiful facility right next to an industrial park. And let's see if I can get this to play here. There we go. Right next to an industrial park and an airport. One of my favorites on our tour. This new self-storage facility that you see here was just opened in 2020. And it's been reviewed by both our operating partner and a third-party due diligence team, and they just did a fantastic job on it. Really well done. In addition to the storage, we have a lot of industrial flex space, which is just fantastic. The market, this market has less than 2% vacancy for this type of industrial flex, and it's a very, very in-demand asset class. Additionally, these facilities are about 50% below market rents. So in the underwriting, I think Jim can speak to this, but in the underwriting, we didn't go crazy and underwrite 100% doubling of our rents there. We only underwrote about a 20 to 30% increase. However, some really attractive demand there, and it comes with a bunch of vacant land to expand with both storage and flex space. Our flex space is 100% occupied, and a lot of really great demand for that. Moving on to Ocala. This is just southwest of Palatka. The new facility in the back is leasing up very fast. It's a combination of kind of Gen 2 and some brand new climate controlled in the back. That's the stuff that's leasing up fast. And it comes with both some residential leases, some retail in the front, as you can see here, and some vacant land. And the vacant land is a little tricky. It's going to be a very tough entitlement process. So we didn't underwrite that, but that could be some icing on the cake there. Following that would be Hudson. And this is a really exciting one because it sits right on a highway with 30,000 daily traveled vehicles. And to give you some perspective here, about 15,000 a day is what retail folks get really spooled up on. So we've got double that. Speaking with the city and county, they're really interested in developing this side of Hudson. And they've told us that they're very flexible with whatever zoning and whatever we want to do with this, because they want to drive more development and more redevelopment of this side of town. So it doesn't only include what you see here, but also a storage facility that's right down the street. There's lots of opportunity here to look at some highest and best use opportunities. And obviously we're in a very favorable jurisdiction, so that's great. However, we haven't had time to sort of figure that out. And so it's underwritten as is. It's cash flowing. There's no reason to do anything with it right now. So we're just going to leave it as is and have it for cash flow. And later on, we can figure out what the highest and best use is, and we can look at expanding and doing some other cool stuff with it. But that's just going to be icing on the cake for investors in that underwritten return profile. Nothing in there about Hudson, just the in-place cash flow. Moving on to Fortson, Georgia. So this is a nice little affluent suburb that we visited just about 30 minutes outside of Columbus. Tons of expansion opportunity here. High demand, not much CapEx. As you can see in this photo, you got about 2 acres of vacant land right here. Already a lot of demand for covered outdoor RV and boat parking. Customers are constantly, when we talk to the on-site managers there, customers are constantly coming in and asking them for covered parking, and it's not something that they have currently. So this is a great expansion play and also an operational capital improvement play. Moving on to Fort Oglethorpe. This is just south of the Tennessee border in Georgia. And this is a cool property. There's 457 units. It was just expanded in 2020 with this brand new climate controlled facility in the back of the property. In the front and middle is that old sort of Gen 1 that you see there. And then on the street frontage, this is the one that if you watched our video is just terrible. It's got cars with flat tires and weeds growing through. And so the frontage on this property is really, really bad. A lot of opportunity to make it look nice in the front of the facility, and that'll help with the overall pricing. In addition, you can see that all this vacant land here. We've talked to the city, and they said that we could develop some additional land. However, we just got the certificate of occupancy on the brand new units in the back. And by the way, those, when we visited, were completely vacant, had just finished construction and hadn't even leased up yet. So we're going to see how the lease up goes on that first, and then we can consider some expansion there. From there, we went to Columbus. This is closer to downtown Columbus, home of Fort Benning, which is the maneuvers center of excellence for the U.S. United States Army, where infantry and armor schools are. And that base is not going anywhere. Very stable client base. It's always rotating in and out. And it's also the home of multiple training units there. So not much to be done here. Facility's in great shape. There's really no room to expand. So it's just a operational turnaround and clean up, optimize the customer experience, marketing, and give it some improvements, put the operator's brand standards on it, and increase the performance. So this is a nice little cash flow anchor in the portfolio. In Lake Park, this is a retail and storage facility, and you'll be able to see here that it comes with this huge parking lot and a bunch of vacant land in the back. So lots of land that has really nothing's been done to it, and it's just sitting there waiting to be expanded. Drive aisles are in really good shape. When we flew the drones over the roofs, roofs are in really good shape. So really it's just an expansion play. And the signage here is also really terrible. It's on two major highways. And when we drove up, we could barely find it because there was no signage. We'll talk a little bit about that later, but signage is a big issue on all of these facilities, and it's going to be addressed. Finally, Warner Robins. This is about an hour south of Atlanta. And actually, it's funny, the operator had a facility in this exact market. In fact, if you look just to the top of the screen here, just off the frame across the street, there's another storage facility that the operator used to own, and they sold it to someone. And I personally actually have a private debt note on that facility. It's called Storeway, and there might actually be an opportunity to buy that as well and put that into this exact same portfolio. The previous owner put a really nice, really great on-site manager there to clean up the property. And this is just kind of an operational turnaround. They're halfway through their value add strategy, cleaning the place up. It's still a little bit low occupancy. So we'll just continue that value add play and clean up the occupancy, clean up the facility with paint and some deferred maintenance, as well as expanding the facility over on this vacant land over here. And Centerville. So Centerville is just southwest of Nashville. And this, to be honest, is it's the ugly duckling of the facility. Even though we got some really pretty drone shots here, it really has been neglected for about the past 5 years. It's got a lot of deferred maintenance. Out of the 503 units there, about 80 are down from maintenance. So they're unrentable. So we're going to come in here, fix the drive aisles, fix the roofs, get those units back online. And this is in a market that is over 90% occupied. And this facility is sitting at about 70. So fantastic opportunity to get in there, professionalize operations, put an office renovation in there with some ancillary revenue streams and really optimize the property. So we're excited about this one, the potential there. So again, just overarching improvement plans. We've got, first of all, the capital improvements. So we're going to repair drive aisles, recoat, give it a fresh, clean look. We're going to repair all the roofs, make sure they're leak free. We're going to renovate all the offices to provide an enhanced experience and add storage retail goods, boxes, tape, all that sort of stuff that can add ancillary revenue and just makes your facility more convenient. We're going to repaint and repair all the building damage, replace all security cameras with modern systems. So any of the facilities that have outdated systems, we're going to completely redo the security systems and enhance the signage. Again, this is a big one. We've got a $250,000 signage budget just because we're transitioning the old affordable brand to the sponsors national free up storage brand. And so all new modern signage is going in, as well as the renovated offices and the drive aisles, just to make them look really clean, professional, and new. As far as operational improvements, again, putting the operating partner's brand standard on the facilities, increasing all these rents up to market rates. Staff training to enhance the customer experience. The operating partner has a learning management system right in-house to train their staff. Develop those community partnerships to do cross marketing opportunities and develop corporate business relationships, as well as adding ancillary revenue streams such as tenant insurance, propane, U-Haul, merchandise sales, boat storage, ice and vending. and even exploring some cell phone tower contracts where that makes sense. So the sponsor, in addition to just bringing a level of sophistication that the previous owner just didn't have, does both property management and asset management. So under the asset management umbrella, what they're going to keep tabs on is the market, keeping tabs on what the market's doing and having that market intelligence there, the life cycle of the property, when to dispose of the asset, and then with financial, managing the financial levers, right? Managing revenue, managing expenses, and managing debt. For liability, they will be keeping an eye on what insurance needs to be carried on all the properties, and we cover all of these with full scope insurance that covers anything from weather to riots. Property management. A key part of property management is revenue management. And so one of the reasons why this particular operating partner brought property management in-house is so that they can keep closer tabs on the facilities. And we've in our past deals with this operating partner have been very impressed with their property management. They use a system called Store Edge. So revenue management system similar to the airlines, which as a specific unit type starts to get leased up, it'll start bumping the price of that. They're standing up an internal marketing team to make sure that from a digital and physical perspective, we're driving as many customers to the facility as possible. We have an in-house maintenance team in order to make sure that everything is always fixed, and if there's an issue, that it's fixed on time and fixed correctly to give our customers the highest experience possible. And then while self-storage is a much less regulated asset class than some others like multifamily or senior living, there are regulations that need to be complied with, and especially with auctions. And with that, I'm going to turn it over to our CFO, Jim Morales, to walk through some of the financials.
Look at that guy. Hey guys, thanks for taking the time tonight to attend this webinar or watch it on the replay. I want to run through the financials kind of real quick. I'm sure you guys are tired of seeing my bio there. But just to kind of summarize, I have over 20 years of experience. I've underwritten properties. Currently work for somebody that has over 9,000 units of multifamily properties. Next one. Yeah, traditional financial disclosures here. All the information here is preliminary and audited, and obviously subject to revision, although we think it's pretty final. All of these are forward-looking statements. Obviously, do your own due diligence. Don't take anything here as gospel. So Ted, I believe you touched on this early on the debt summary. We can skip past that. That's not part of the deal here, but I do want to focus on the financial projections for this. Our operator is a very strong partner, and their underwriting is usually pretty solid. One thing I want to call out is you see the significant increase in storage rents from year 1 to year 4. That works out to about almost a 50% increase, and that's primarily driven by two major prongs. First of all, the facility expansions that Tate mentioned earlier. To be honest with Tate, I believe it's about 90,000 that they have currently planned, and that could scale to potentially more. And then they're also going to tighten up their collection processes right now, and also get the market rents, with all the current rents they have right now, increasing by about 10%. So that's what's driving most of that increase from year 1 to year 4. In addition to the recently constructed units that came online, they'll be leasing those up through a targeted marketing campaign. That's also driving some of the increase you see there. And I already talked about the increase in collections. The operator has already seen, just from the time of going hard on the deal, they've seen the collections increase just due to that sophistication that Tate mentioned that the prior operator did not have. One of the things I wanted to highlight on this slide is you see a box store that a debt service coverage ratio, DSCR, is pretty rich in year 1 because of that significant increase that we'll see in improvements in collections and improving the rental rates to market. So on the operating expense side, most of these are traditionally driven by some assumptions that are made, and also by how they're planning to lease up the space. But one thing I do want to call out here is the property tax. You see how that significantly increases from year 1 to year 5. That's primarily driven by the expansion plans. Obviously, the more property you're generating business off of, you have to cut your local government in on the action. So you see that significant increase. A lot of underwriting kind of hides that in hopes that maybe you find it. And it's to our operators' credit that they already went out there to market, did the research, and partnered with some accounting firms to properly project that out.
Excellent.
So yeah, this was a slide I was going to talk about the cap rate expansion for final valuation at year 5. So you see at that 5.81 cap rate percentage, we're projecting that the property would be able to be sold at a almost 55.5 million, which is a very nice value spread over what the units are being acquired for at this point in time. Okay, so yeah, so valuation analysis. So Kate kind of summarized this in an earlier slide, but you'll see basically a lot of the returns are going to come from the gains from the sale, in addition to the yearly cash flow. We are projecting this is going to get sold in year 5. Cap rates nationwide are below 6% and seem to be compressing, aka getting lower, but we're projecting that they actually go higher. If they continue to compress, obviously, that would drive a higher value. And again, we're projecting that it's going to be sold at a 5.81%, pretty conservative, based on some underwriting models I've seen. Next slide. This is a recap of what you had earlier there, but just to rehash it, now that you've talked about some of the underwriting. Minimum investment of 50,000 gets you about a 0.2% ownership with a 7% preferred return. The cost seg study that will be done year 1 and the associated accelerated depreciation is estimated to give this position about a 15K tax loss. So you get that benefit on your taxes. Most of the return is going to be from the sale. So you see it there about just north of 30K. And then total overall returns is just shy of 93%. So an equity multiple of 1.93, almost doubling your money in 5 years. And that's with extremely conservative underwriting. One of the things that I do, even though I always like this operator's underwriting, is I really try to stress it. And I believe on the next slide, Tate, they have the scenario analysis. So this gives you, and you should always demand this from any operator or any deal that you're looking at, is basically a range of possible outcomes. That kind of give you a sense of how serious this operator has stressed their own assumptions. And that's one of the things I like about our specific operator. They do a great job at challenging their own assumptions and really trying to beat them up to predict the unforeseen and try to see how that might impact the actual returns. So in this case, and I'm extremely confident that these returns would fall between 13 and about 27%. And there's a potential that it could go even higher with some things that are not baked into their underwriting that Tate had touched on, some of the expansion plans, some of the other opportunities. There could be an opportunity to maybe refi this which would also boost returns. But without any of that baked in, you see a nice healthy range of returns here, with the most likely case winding up with that equity multiple of just shy of 2x.
Yep.
And what I do on my side, before I go into the next one, is on my side, I try to beat it up even further. The pessimist in me and normal CFO in me always try to think of total worst case scenario, an economic crash, some sort of other doomsday type scenario. And I really couldn't beat this up worse than their worst case scenario. I think I might have gotten it down to just sort of about 11% return after I really beat it up. So even with that, that's still pretty decent. But we think we're very confident that we're going to outperform what the projections are here.
Couldn't agree more.
Next.
Thanks, Jim.
Next and final slide for me is I always try to give a scorecard for the underwriting, and I typically try to center it around 3 main prongs, and that's the sponsor's track record. I definitely give our operator an A. They have over 6,700 units. They've completed 10 projects, and we have a prior existing relationship with them. So we trust them. They do good deals. They're conservative, and we like the way they operate. We also, and you should always look for this, operators that have skin in the game, and how much skin in the game. And without disclosing any specific numbers, both the operator and Turbine are contributing capital to the deal, which means we believe in it for our own financial situation. And the operator itself is very invested in this deal. That's how much they believe in it. And then on the underwriting side, I always look for how conservative the assumptions are. You can always make a deal look great with aggressive assumptions. Making it look great with conservative is a lot harder. And our partner does a great job at really being conservative and realistic and under promising and over delivering. Some of the things that I've kind of talked about them already. We have the cap rate expansion already built in. There's potential other construction expansion options that were mentioned earlier, but are not included in the underwriting just because the plans are not set in stone, so they didn't want to overpromise that happens. And there's other things in there other than their assumptions that I thought were pretty conservative as well. They always out forecast the expense growth versus revenue growth, and typically that's a good sign. So and you see, I gave these guys all A's, so for an overall grade of A, which typically reflects how confident we are in the underwriting, their operating model, how their values as a company, and we wanted to share our feelings about this deal with you there. And I believe that's my last slide, Tate.
I think so. Thank you, Jim. I couldn't agree more. I really echo that sentiment on this operating partner. We're in a number of deals with them, and we couldn't be happier with the way that they perform, and that's why we feel so confident, moving forward with this one, especially having visited the sites and seeing it, with our own eyes. Well, I'll take it back over from here, sort of go over the next steps, and we'll get into the Q&A afterwards here, but I just want to quickly go into next steps. If you're interested in looking at the offering memorandum and legal docs, we're really excited about this new investor portal that we're signed up with. It's an excellent piece of software. It's at turbinecap.investnext.com. You go in here, just register an account, and you can see it from there. You go into offerings, and then there it is. So this is what the deal room looks like, and you can reserve your investment there. This is where the investment actually takes place, is right on our portal. The alternative way you can get there is just go to our website, turbinecap.com, click on Investor Portal, and it takes you right there. So with that, I'm going to jump into the Q&A section, and we didn't get any questions directly on this webinar, but I have a few that have come in from beforehand that I'd like to jump into. First off, who's the seller? Why are they selling it? The seller is a couple of brothers out of Florida that are newer to the self-storage game. They entered the market about 4 years ago and started piecemealing this particular portfolio together. They are not very sophisticated. They're getting it, and they've done some really nice expansions, but they didn't do a great job of putting together their equity stack. And I think that they're, quite frankly, their investors are a little surprised at what they can get for it. Albeit there's a ton of meat on the bone to continue to operationally optimize this thing and really get it running on all cylinders. There's just a ton of demand to expand as well, do additional expansion and operational optimization, and then eventually sell to an even more sophisticated operator, which would be, say a REIT. Why are they selling? Well, quite frankly, they've completed their business plan. So that's sort of who we're buying it from. How much? 30 million. Where's all this money come from? So to put this in perspective, this is $36 million worth of private investor money. Well, 23.3 million is going to be in debt, and that's coming from the operating partners their own list of over 1,000 investors who participate in their debt offerings. That has been fully subscribed. There's 12.9 million in available equity, of which we originally reserved 2 million because we love the deal so much. And we just went back to them. They said, well, there's 900,000 left. We've gotten 10 million in firm commitments and funding from their current list. They said, okay, you guys can have the additional 900,000. So we were excited about that. So 2.9 million is coming from us. Why are we pooling this money? You know, what's the point? Why wouldn't we just, you know, play middleman? Well, the reason is because if we pool our resources and we go to this operating partner with a $2.9 million check rather than 50 grand, we can command a much more aggressive due diligence process. You know, Jim will receive access to underwriting files that the general public may not be able to get eyes on. I was able to accompany the operating partner physically for 3 straight days visiting these facilities. And that's just not something that they would have entertained had I just been saying, hey, you know, I'll invest $50,000. But when I'm coming with multiple millions, we can really dig into that due diligence for our investor group, and it's something that we really believe that's important when you're looking at these deals, is to go really deep on due diligence to make sure that it's a solid deal. So that's number one. And number two, we can command better profit splits with the operator. And that's to the follow-up question of how does Turbine Capital make money? Well, we are able to command a better profit split with the operator, and that's what we're able to leverage in order to take that delta, right? So we strive to give our investors the same return profile as they would get had they found this deal and this operator and done all the due diligence themselves. Yet they get the benefit of coming through us and being that conduit who has the relationships and deal flow and the sophisticated due diligence process to make sure that we're selecting great deals. And then on the back end, we make our money by taking the difference between a typical investor from off the street and what we're able to command because we're investing as a large group. So hopefully that makes sense. Let's see what else came in. How much are we purchasing this on a per square foot basis? I thought this was interesting. So we're getting this entire portfolio. It's 517,000 square feet of storage for about $59 a square foot, or $70 a square foot on total project cost. This operator has purchased facilities for as little as $23 a foot and paid well over $100 a foot for properties that are in good shape. So for $59 a square foot, that's a pretty good price. And to give you kind of obviously between markets, there's wild fluctuation in per foot cost because something in Oklahoma is going to trade for much different than something in downtown San Diego. But Easy Storage just purchased, Publix recently purchased Easy Storage, which is a 45 property firm in DC for over $400 a foot. So definitely a lot of per foot premium that we can get. And when you look at cost to build, we're getting at or below replacement cost for these kind of facilities with a whole lot of vacant land for expansion. We really went over who manages the properties. As far as construction expansion, this was something that came up. Someone asked, "Hey, who's doing the construction expansion? Are you hiring that out?" Well, our operator has an in-house construction arm with a licensed GC, and this GC is very sophisticated. Came from a company called Casey Industrial, and they build power plants, telecommunications networks, gas transmission systems. He recently was the key project manager on the ventilation system renovation in the Eisenhower Tunnel that connects Denver with the ski mountains. So obviously this guy who is their in-house GC and their project manager on all of their construction projects is very experienced building much more complicated stuff. I mean, popping up a storage facility is a lot easier than a tunnel ventilation system. And so they have a lot of in-house experience that allows them to not only underwrite very accurately of what it's going to cost to do these kind of things, but also execute at a very high level. How do we fix the delinquency issues? That's something that actually is very simple in storage. They use a third-party company called Late to Lien. That company handles all the regulatory compliance, seizes the customer's goods, auctions them online. And that's not obviously something that we want to go and make money with, but it is something that's necessary, and it frees up the unit to be released. This was interesting. Jim, I'd love to get your perspective on this. What's the break-even occupancy? We found that levered break-even occupancy was what, 72%?
Yeah, that sounds about right.
Yeah, and 72%, I mean, that's a ridiculously low number on a portfolio of this size in order to break even. So basically that means that anything above and beyond 72% of occupancy is free cash flow. How will we eventually sell? What's the exit strategy? Well, there's a lot of different exit strategies on this. We're able to sell, one facility, two facilities. We could sell off a Georgia portfolio or a Florida portfolio. We could sell off the whole thing as one, or we could sell this as part of these 9 facilities, as part of an entire national portfolio of the sponsor's entire national portfolio that's spread out across the US. And that's actually probably the most attractive option because in that case, we'd be able to do sort of some sort of $1 billion buyout to a publicly traded REIT. What would trigger an early disposition? So this kind of ties into 2 questions. Is a 5-year hold period reasonable? Do you think that we are going to hold it for that whole 5 years or longer? And well, there's about 50 to 80 companies out there that are larger than this particular operating partner. And the top 20 to 30 of those are beginning to have tens of billions of dollars poured into them by the institutions. And so they're hunting very aggressively with very aggressive pricing, trying to buy up storage assets. So if we were to be approached by one of those larger companies and we're offered a price that made sense, then yes, we would exit. That would be in the hands of the operating partner. They're the general partner. They're the ones that make the decisions. And obviously, because there's incentive alignment between the investors and the operating partner, they would obviously be acting in the best interest of both themselves and their investors by either deciding to sell or deciding to hold. If we were not approached early on in the hold period, really the thing to remember is that the idea here, the whole goal is to get in there, complete the business plan, which is adding value, expanding, increasing operating income to increase the valuation, and then to exit. So if we can complete that business plan in 2 years, 3 years, 4 years, then we will have completed the business plan and we will be looking to exit. Doing a 5-year hold, we have to project it to be something, and we want to give ourselves a nice 18 to 36 month buffer to complete that business plan should we not be able to do it in the timeline that we kind of internally think that we could do it. A quick tax question. Will I receive a K1 for each of the 9 properties in the portfolio? No, you'll receive 1 K1. Let's see, how much bonus depreciation? We went over that. This is an interesting one. Can I invest through a self-directed IRA? Yes, you can. However, time is a little bit of the essence because you're going to have to roll into a self-directed IRA. There's about 2 dozen out there that are great. We've looked at a number of them. I have an account with sort of a legacy company that I'm rolling into our new partner, Alto IRA, and you can find out more information on them by going to our website, turbinecap.com, and under resources, SDIRA investing. You can also just reach out to me directly. I'd be happy to help you out. And again, how do I invest? Well, go to our website, click on Investor Portal, and that'll lead you to register, come to the deal room, hit reserve now, and you can certainly participate in this offering. That's about all I got. Jim, do you want to add anything before we sign off?
No, the only thing, if you couldn't tell already, we're very enthusiastic about this deal, and mostly for you guys, for the investors. He's a solid operator. These are solid properties. We definitely believe in the asset class strongly. And I think this is one of the deals you want to hop in on.
I would agree. I think it's fantastic, and I'm putting my money where my mouth is. I can tell you that. So we'll this certainly isn't the last deal that'll come along. We'll be out there looking for more storage opportunities and opportunities in other asset classes, but this is one that I'm very excited about. I get the opportunity to look at it closely, personally, and it's one that I'm really excited about. And so if you have money to place, take a bet on us, 2 to 6% and of maybe your net worth, and tie your wagon to our horse, because we're going places. Well, on that note, I'll take us out. Thanks, Jim. I appreciate it. Any questions, please contact info@turbinecap.com or tate@turbinecap.com. Be happy to answer any questions after the fact. Take care, guys. Aloha.
Good night, everybody.